All right, ladies and gentlemen, we're going to get started. Good afternoon. Our topic today is private equity and venture capital regulation since the Dodd-Frank Act. Hopefully we're going to have a dialogue on how the regulatory environment is working and the various lessons learned. We're going to try to have this session as participatory and interactive as possible. Have any of you ever been to a program where it's just a bunch of droning, talking heads yelling at you? Anybody been there? Let's have a show of hands. Shocking that other people have had this experience. We hope this will not be that. That's our objective. What we hope to do is to tee up a bunch of questions, to have a bunch of very informed people address those questions, and to have a conversation not only among our panelists, but we've got two microphones, all right? We want to be able to answer your questions. We want to be responsive to your concerns. We want to get your reaction and your input so that we really have a constructive situation where our panelists can listen and learn from you as much as you might be able to learn something from them. That's our objective in this situation. We're going to begin with a very brief series of self-introductions. Hi, I'm Joe Grunfest. I'm a professor here at Stanford Law School. I actually used to be a commissioner of the United States Securities and Exchange Commission, but I'm better now. Thank you for asking. John?
I'm John Monsky. I'm a general counsel and partner at Oak Hill Capital. I basically do M&A transactions at Oak Hill, which is a private equity firm.
I'm Erin Schneider. I'm the Associate Regional Director for the San Francisco office of the SEC.
I'm Margot Worth. I'm the Director of Private Equity at CalSTRS. We're the second largest public pension fund in the country and also the second largest pension fund in Sacramento. Sarah?
but he's counting, right?
Sarah Core, Senior Portfolio Manager at Calpers in the Private Equity Program. I oversee risk, research, analytics, and performance for the group.
And I'm Drew Bowden. I was in the industry for 25 years, and 3.5 years ago, I joined the Securities and Exchange Commission. I'm currently the director of the Office of Compliance, Inspections, and Examinations, which is a mouthful. In essence, on behalf of the SEC, our team, about 900 people spread around the country, we go out and we conduct on-site examinations at every variety of registered financial services firm that there is.
So, Drew, since you're the most feared man in the room right, at the moment, why don't we start with a couple of basics? All right, and let's start with the question, what's the distinction between a registered investment advisor and an exempt reporting advisor, the former typically being private equity and the latter typically being venture capital? I mean, how does this work, and what does it mean? What are the implications?
Okay, this is a tough one because we didn't want to do talking head drones, and I've been asked to talk to you about the distinction between registered advisors and exempt reporting advisors. But I'll do it my best. But first I have to give my disclaimer, which I'll give on behalf of Aaron and me, and Joe, you're familiar with this, that the views we express today are our own. They're not necessarily those of the Commission. The Securities and Exchange Commissioner has 5 commissioners, and it can only act through the majority vote of those 5 commissioners. So any rule that gets passed, any enforcement action that gets brought, goes through the commissioners. Neither Aaron nor I are commissioners. We also always say that the views we express to you today are our own. They're not necessarily shared by all of our colleagues in the commission, who number about 4,000. So for the purposes of your question, what's the difference between a registered advisor and an exempt reporting advisor? I'll give you the 30,000-foot level. So pre-Dodd-Frank, basically advisors to strictly private funds. So your typical hedge fund manager, private equity manager, venture capital advisor, they were exempt from registration under the Investment Advisors Act of 1940. And so from our perspective in the Office of Compliance, Inspection, and Examinations, non-registered, not really on the radar screen. With Dodd-Frank, one of the things that happened in there is they repealed that exemption. So that if you were an advisor to hedge funds, private equity funds, or venture capital, in the first step, and you managed more than $100 million, you needed to register. But the other thing that they did in that ecosystem is they passed some exemptions so that if you're an advisor solely to venture capital, you don't have to register, but you may file what's called an exempt reporting advisor. So you file limited filings with the SEC. You're still subject to the anti-fraud provisions. And I think at the time that the changes came out of the commission, the Commission sort of signaled that exempt reporting advisors, again, from our perspective in the exam program, that we were going to focus on registered advisors of all shapes, investment advisors, mutual funds, other people, and exempt reporting advisors would sort of be off to the side, and examinations would occur really only for cause or for some special region. So 30,000 feet pre-Dodd-Frank, you're an advisor to private funds, whatever shape and size, you're not registered. Post-Dodd-Frank, hedge fund, private equity, become registered, venture capital, still get sort of carved out into a special category. And so we can,
all right, so we have two tribes of advisors. We've got the reporting advisors and we got the exempt advisors. Aaron, from the perspective of the SEC's enforcement division, what difference, if any, does it make with regard to someone being a reporting advisor or someone being an exempt advisor? And has there been any litigation activity that might underscore that point?
Sure. I mean, just as a general matter, the SEC Enforcement Division has always had enforcement authority over the PE space and the VC space, and that's to ensure that those advisors are acting as fiduciaries and not committing violations of the anti-fraud provisions of the federal securities laws. So the types of violations that have typically fallen in those categories are failure to disclose conflicts of interest, failure to disclose related party transactions, failure to disclose fees, issues with valuation. We have brought a lot of cases in those areas already. They're the same that are at issue today. So I think what registration has changed, along with kind of the increasing sophistication of the enforcement staff by way of the asset management unit, as well as our examination staff through their private funds unit, is our understanding of and visibility into these types of advisors. You know, our examination staff has now gone at and been able to see kind of up front and close how these businesses operate, what issues they're facing. Both the enforcement staff and the examination staff have been making efforts to hire experts from the industry so that we have a much better understanding of how it's working and where the issues are. And obviously there are a lot more process-based rules that registered investment advisors need to follow, as well as exempt reporting advisors, which a lot of the VCs in this region fit into. And just one example of something to highlight, you know, to illustrate that the Commission is, you know, willing to flex its muscles in this area and taking these rules seriously. Last year, in 2014, we brought a case against a VC advisor called TL Ventures. They were an exempt reporting advisor, so the Commission found that they had violated the pay-to-play rule, which is one of the rules that exempt reporting advisors still have to comply with. They're not subject to the full panoply of rules that registered advisors are, but there are a subset of them. And importantly for this audience, the Commission also found that TL Ventures failed to register as required. Now, TL Ventures was a VC advisor, so they claimed an exemption under the VC provisions, but they had a related investment advisor that was an advisor to a private fund, which separately did not register because it was under the AUM threshold. The Commission found there that while these advisors were separate legal entities, they advised different funds, they were operationally integrated. They were owned by the same people, they were controlled by the same people, and they were operationally, the people who were making the investment decisions were the same. And so they were actually found that they should have registered. And that, I think, is important for this audience to really take a look at whether you should be registered or not. It's not that the advisors were formed at different times. It's not that they advise different types of funds or different types of businesses, but really what the advisor is doing as a whole.
So at least two takeaways over there. Just because you're exempt doesn't mean that Aaron isn't going to come and get you. All right, so that's one point. And number two, you think you're exempt, but you may not actually be exempt, at least in the eyes of the SEC, once they come and look at the overall structure of the organization in which you sit. So I think those are probably two pretty important points. Now, as difficult as it may be to deal with Drew and Aaron, I think that Sarah and Margot are probably the two most popular people in the room, given the hundreds of millions of dollars of assets that you have to allocate among people who are otherwise asset managers. So we basically go from yin to yang, all right? So Sarah, let me first ask you, how does Calpers decide to allocate funds to private equity and to VC, and why haven't I gotten a multi-billion-dollar allocation out of Calpers?
So I think for any investor, it's important to take into account the fact and circumstances of that particular institution. And as Calpers is so large, and the private equity portfolio is $30 billion of NAV and $12 billion of unfunded, it becomes really hard to invest in venture capital. So Calpers invests where there can have an impact on the portfolio, and as such has a very small allocation to venture capital and focuses most of its allocations to buyout strategies. We have a portal where anyone is welcome to submit their proposal, and I welcome you to submit your proposal to us.
Just a second. How do I get to that portal? And Margot, in terms of your fund's operation with regard to investments in VC and PE, which you do, what do you look at? How do you do the due diligence? What kind of factors do you consider? To what extent do you look at the legal types of issues that we're exploring here?
Well, we do both. We have about 5% of our portfolio in venture. I might add, when I joined the program in 2001, the big stress was, we need more venture. We were looking in the rearview mirror, and then the buyouts just doubled and doubled, and I think doubled again, and became such a large proportion of our industry that has become our main focus. But we do still have about $1 billion worth of venture investments, and as I tell new people on the team, it's like a different country when you come to Silicon Valley. The rules are different. It's a different attitude.
We like that.
They'll write up an agreement, and hey,
the rest of the country, we kind of like it.
Well, it is interesting. You didn't think of this. You didn't think of this. What happens if this happens? Oh, well, we didn't really think of that. We'll figure it out later. Can you please sign the agreement by Tuesday, sort of thing. And so, but if we're going to play venture, we do have to, kind of follow the customs and work in that environment. So we have the same process, the same legal review, but one in Rome.
And John, from your perspective, you really have to deal with all of these different constituencies. You've got the regulators, you've got, your limiteds and your investors. So there's a certain sense in which you're beholden to everyone sitting to your right, all right? And you now have a different set of relationships that have evolved because of the Dodd-Frank regulations that have come into place. How has your life changed because of these evolutions?
I think it's been, for us, we've found registration to be a good thing. We actually registered in 2005 before Dodd-Frank because we thought it'd be better for our LPs, better for us. It was more of a policy decision, but in the short term, we saw very strong effect in terms of we increased our staffing and compliance, we increased our employee training, we increased the level of our policies. But the more interesting thing to me, Joe, it's sort of over the long term, which is now that we've been registered for 10 years, which is our compliance team is embedded in the firm. So it makes both of my constituencies happy here. So they're at the investment committee meeting, they're at the valuation committee meeting, they're at the Monday morning deal team meetings. And as a result, they do a better job, and we think we avoid some of the issues that the staff has seen post-registration with firms that have had less time to really get into that culture and that mode. So it's been we've been happy with registration going back 10 years now. We think it's done good things for us and allowed us to do exactly what you're talking about, satisfy both of these groups at the table.
So in a certain sense, the challenge that you really face, John, is not just compliance, but efficient compliance. All right. How do you wind up dealing with the very thick rule book that you've got at the SEC in a way that doesn't drown you with overhead in terms of armies of compliance people running around saying you can't do anything?
Yeah, exactly. And if you leave the compliance officer down the hall, it's very costly. Right. If they're in and everybody has this in any business, then you're going to have to walk down the hall, explain to them everything that's going on, and they're going to be working with blinders. If you put them in the room, it's very much more efficient. They can go do what they need to do. They can say, oh, we need to amend the ADV, oh, we need to improve the LPA, the limited partnership agreement, etc., or we need to go to the advisory board. So the key for us has been to put them in the firm. It takes a while. People get used to it. They get interactive, and they actually support the operations. But you're right on. Efficiency is a huge thing. I have a constituency that cares about efficiency. my investors, and doing it quickly and well.
Yeah, and just as an aside, for many of the reasons that John pointed out, if you're really going to have a good compliance function, it actually turns out in many ways to be cheaper to run a good compliance function than to run a bad compliance function once you look at the costs all in.
It's not even close.
Right.
Yeah, not even
So,
close.
Drew, let me take it back to you. What observations do you think the SEC has about private equity advisors after having conducted a very large number of exams over the last couple of years? And if you could summarize, dare I use the word mistakes, let me use the word issues, challenges. What are the types of issues and challenges that you've seen come up most frequently in the private equity space that give the SEC examiners a little bit of agita, if you know what I mean?
Okay. Well, some of this will be reviewed for some. We actually gave sort of a public statement about a year ago, I think last April, in terms of our observations from our examinations that we had done in private equity. And I'll just recap briefly, because you can go read that if you sort of want to go by the blow by blow. I'll recap briefly at a high level sort of what the major observations were. I think at the beginning, sort of two of the misunderstandings as private equity funds became registered and we went out to do exams. So some of the questions that I usually get is sort of why are you picking on private equity, and why have you tilted sort of your exam program disproportionately to private equity? People sort of ascribe to us, well, you don't like the 2 and 20 fee structure, you don't like monitoring fees, you don't like the collection of transaction fees, and so the SEC is out there because it doesn't like these fees. And I said, well, that's not true at all. I think at the SEC we recognize, private equity has done a fantastic job for investors. It's delivered really market-beating returns compared to any other asset class over the last 10 years. So what we're really focused on in the exam program is not any particular policy or other political type agenda, but simply we're focused on transparency and disclosure. So where our exams really start is focusing on people like Margot and Sarah are negotiating with private equity advisors or venture capital advisors or hedge fund advisors for a deal. And so our examinations typically begin and end with, what did you tell your investors you were going to do? And then our examiners have the ability, unlike I think Margot and Sarah and their team, we can go behind the curtain and talk to people and look at documents and get whatever we want. And we're trying to answer the question of, okay, so this is what was promised, now what was delivered. And so we're really focused on the disclosure, the transparency, and whether there's alignment. What we've seen, again, at a high level in terms of our exams of private equity, is we saw disconnects, what I'll just call non-compliance, right? Non-compliance with the terms of the deal, really in three principal areas in private equity: are fees and expenses, sort of what fees am I allowed to collect, and how do expenses get allocated as between me, the manager, and my fund or other side investors. Two is favoritism, or how do investment opportunities get allocated amongst different funds, amongst people in the fund and people who may have co-investment opportunities outside the fund, including the principals of the firm. And then third, valuation. How is valuation actually conducted? So I'll maybe stop there for 1 sec and use that again as an example of what I'm talking about. I think a lot of people misperceive on valuation that our examiners are going to come in and challenge people and say, well, this private company is not worth X. It's worth X minus 2%. And so we're going to challenge you on the merits of your valuation. We're not doing that at all. That's really not a good use of our time. I think having been in the business, valuation sometimes is a difficult, reasonable people could deliver. Rather, what we're doing is we're simply asking people the question of, how did you tell your clients you're going to value their investments? What is the process that you told them you were going to follow? And then is that what you actually applied? And so where I would say, on those types of issues, we're not painting a Vermeer. We're not there with a one bristle brush doing fine coats. I say we generally are painting, with a 4-inch brush in terms of what we're doing. But where we see problems in valuation is, I told my clients I was going to use a particular valuation methodology, and I didn't. I used a different one. Or I switched my valuation methodology from quarter to quarter or year to year in terms of what I do. So those are the types of things that we saw: fees and expenses, allocation of investment opportunities, and valuation, I would say, at a high level in that particular business model.
So I believe there's a law of thermodynamics that says if the Office of Examinations finds a problem, then the enforcement division will sooner or later find a cause to litigate. Is that about right? Is that about right, Aaron?
That can be right in certain situations, Joe.
I would say
That's why it's like a law of thermodynamics.
about my stats, so I say, we like to go on data. As it turns out, in our examinations, our program refers about 10% of the examinations we do to the enforcement division. So we find deficiencies about 85% of the time. That's across the whole industry, right? If you let my examiners in any of your shops, we can find a deficiency of some magnitude or another. So deficiencies 85% of the time. Referrals to enforcement where it's significant enough where we say, hey, wait a minute, this ought to go to our colleagues about 10% of the time. And then once we hand it off to them, it doesn't mean there's going to be enforcement. It just means Erin and her team are now going to review what we found and make a determination on behalf of the commission. Is this a good use of the commission's resources to bring enforcement action?
So Erin, when do you come down heavy?
So I don't have stats like Drew, but it is true. I mean, there is a subset of the deficiencies that are referred to of enforcement, and then there is a subset of those referrals that enforcement actually investigates and makes a recommendation to the commission. I thought it would be helpful to talk a little bit about what I look for as an enforcement person when I have that referral in my hand. OC and I do work collaboratively, so OC enforcement are working collaboratively, discussing these issues all the time. I think generally speaking, OC will identify a deficiency, and we really want to get to the bottom of why this happened. Was it an intentional act on the behalf of the people that work there, or was it some sort of widespread failure? Just because it wasn't an intentional act does not mean that enforcement will not be interested in pursuing it. I think sometimes just wholesale failure to pay attention to certain compliance-related areas can end up causing a lot more harm than an intentional act. So that's something that we'll be looking for. And then just, who really was responsible for it? I think we have a mandate from our current commission to hold individuals accountable, and that's something that we're looking for. Was this a particular person's fault, or was it just a broader process failure that nobody can be held accountable for? And then, there are certain issues that we think the commission needs to speak publicly about. The examination findings, the deficiency letters are issued to the firms. Firms may or may not pass them along to their LPs when they ask for them. I'm sure that several of you in the audience will cringe at this, but we don't have enough resources to go out and look at everybody. We really depend on some sense of a public-private partnership to, get the industry to police themselves, which I think has benefits for everybody at the end of the day, as John was mentioning. So just briefly, these are, 3 things I look at. Are you acting as a fiduciary? I think a lot of times we hear from advisors, our interests are aligned, and I'm not sure that is the same thing in certain situations. I can just make up an example, but, a fund that you're advising needs cash, or portfolio company needs cash, the fund doesn't have it, and so the advisor makes a direct loan without running it by the advisory board, without telling anybody about it. The advisor may say, this is in everybody's interest. I'm not sure that's the same as being a fiduciary. Number 2, do you have well thought out, documented policies and procedures that you're following? And 3, are your fees and expenses really actually disclosed to the LPs? I think we hear a lot that LPs know exactly what's going on in this business, and I don't think that that's consistent with what we hear when our examiners go out and talk to LPs or when enforcement goes out and talks to LPs as well. So just to highlight one case, just as an example, we brought a case last year in 2004 against a PE advisor called Clean Energy. This was a case where the GP had allocated a bunch of improper expenses down to the fund level, things like GP salaries, GP benefits, rent, a wide variety of things that, as you can imagine, shouldn't be borne by the fund. This particular GP had policies and procedures, actually saying that these types of expenses were prohibited, so pretty egregious set of facts, which is why enforcement action was brought. But you can imagine that this can happen in more nuanced ways. I think Drew has spoken about this, and there's been conversation about, consulting people that provide advice to the portfolio companies that used to be paid by the GP are now being pushed down to the fund. Valuation services that used to be provided by the GP in-house are now being automated. That's being pushed down into the fund. Reporting mechanisms that used to be borne by the GP are being pushed into the fund. So there are more nuanced ways that this can happen that you can get in trouble from an enforcement perspective. And then I just wanted to give you a sense of some of, we haven't brought that many cases in the PE space since Dodd-Frank has come. I think you will see more. I think you will see them in the fee and expense area. And I wanted to give you a sense of just what we think about in enforcement. Our funds, our advisors offsetting against the management fee, all the fees that they're getting. I think there's a general sense that this offset provision helps everybody and benefits the LPs, but I'm not sure that all of the necessary fees are being offset. Our advisors creating new classes of fees to avoid the offset. The acceleration of monitoring fees, especially when coupled with an evergreen provision that will accelerate those fees beyond the initial life of the fund. I think enforcement will have an interest in that. And I think that'll give you a good sense of what we're looking at. I think you will see more cases in this area over the next year or so.
All right, so if I'm to understand our friends from the SEC, they're basically in business to protect Margot and Sarah from people like John. Is that about it? That's what I've just heard. That we need to protect them from predation, all right, by people like you. So that's about what you've said, isn't it? I mean, I'm not paraphrasing too badly. So let's first go to Margot and Sarah, and then we'll turn to John. Margot, from your perspective, how transparent do you feel the fees and expenses are by the GPs? Do you feel there's stuff going on there that you don't understand? Because the story that I've heard is we're not telling anybody which fees they can charge, and we're not telling them how can they describe the fees. We just want to make sure that the LPs understand what's going on, and the GPs are following the rules that they've agreed to in the deal with the LPs. So how comfortable are you with regard to disclosure and transparency in this space?
Well, I think there's been a lot of improvement, but it still has a long way to go. And I'd just like to go back to, say, 2008, which isn't that long ago in private equity. We're in 15-year funds. That's not that long ago. And the industry, again, was doubling, and there were $5 billion funds. Then there were $10 billion funds, and 2 years later there was $20 billion funds. And so we would negotiate with the firm, and they would tell us we're going to get full disclosure on all fees and expenses. We would show up at the advisory board meetings once or twice a year, and there'd be a 1-hour meeting. The GP would go through and tell us about developments at the firm, maybe discuss a conflict issue. You'd start to hear the rattle of dinner being set up in the next room at 6. It's about 15 quarter till, and this is and you're sitting there as a LP, and you look to your left, and there's 1, 2, 3 GPs, and then there's another LP, and you look the same way. You've been separated, and they make the disclosure, and it's fully disclosed. It's portfolio monitoring fees for the year, X million, transaction fees, X million, and it was 4 numbers. And the industry suffered from the excesses, and when the economy went down, the industry suffered, and so that has been a main focus. And so the LPs got together and started demanding more transparency, and one of the things we asked for was in-camera sessions. And so now what we insist on is after we have the meeting, we ask the GPs to get lost for an hour, and we talk, and then we come back to the GP and say, we really don't like this disclosure. We want it by company, by year, and cumulative. And so I think there's still a lot to go, but I think the combination of the LPs standing up for their rights and the SEC going and digging in deeper than it's really difficult for any one LP to do is changing the industry. But there's still room for improvement.
Is your experience similar to Margot's? Would you like to see more uniformity in the industry? Would you like to see the use of templates? How do you see ancillary fees impacting funds? All these other miscellaneous. I mean, you run a huge pot of money, and it's fascinating.
It gets charged a lot of fees.
Yeah, and it's fascinating that from putting my professor's hat on for a second. You're probably the largest, most sophisticated set of investors in the world. And yet what we're hearing is you can't fend for yourselves. That in your negotiations with the GPs, either at the VC firms or at the private equity firms, you're still not able to get what you think you want or what you think you deserve, and you still need the protection of the SEC, just like you're a retail investor. What's going on here?
Yeah, I would say we have at Calpers had similar experiences to Margot on transparency of fees. Calpers has required the general partners to use the ILPA template for capital calls and distributions for 3 or 4 years now, and we get pretty good compliance with using the template format. Where we do run into problems is using all of the data elements within the template properly. So quite frequently we have to go back out and ask again for what was the gross management fee, what was the offset, what's the corresponding net management fee. So they're putting it in the template, but they're not disclosing all of the information that we're hoping that they do. So that's an area where it requires a lot of staff time to go out each time you get a capital call for management fees and ask for the additional information that there is required to be disclosed in a lot of the partnership agreements that we have. So we do spend a lot of time trying to get that information, and a lot of experiences at the advisory board level where they're required to disclose maybe 2 or 3 types of fees in the agreement, and there might be 4 or 5 that they're charging. So you don't get disclosure on the fees that they're not required by the agreement to disclose. Some of the things that we do is we send out our internal audit and our compliance team to do reviews to make sure they're complying with the agreement. Actually, Brian McQuaid is out there, and he does some of the compliance reviews for us. But it's challenging, and GPs aren't as transparent as you would like them to be.
I would just like to add one thing about the leverage. A lot of the firms stumbled in the global financial crisis, and some of them were injured and could not raise funds or had a hard time raising funds. And in those situations, a firm like a CalSTRS or Calpers could say, okay, let's start with a clean sheet of paper. We might be interested. We think we saw what happened. We think you still have talent, and we could really move the needle. But some firms went through the global financial crisis and returned 25% net. And so when those firms come to raise another fund, there's people lined up behind their door. And in those situations,
so people will actually pay for good performance.
They'll pay.
So is that the problem?
It's a market mechanism, and so you might feel like I'm willing to pay a higher fee to be in a higher performing fund, but they might say it's higher performing, more fees, but also you can get lost on us changing the agreement. It was good enough in 2007. We've read everything that's gone on in the press. We know you'd like better disclosure. We know you'd like more clarity, but we're closing, and we hope you're in, but you can take it or leave it.
And so let me ask a bold question. What's the matter with that? I get take it or leave it deals all the time. There's
nothing. Well, I think, and in cases we've said we'll leave it.
Right. In other cases, you
but
said we'll
I think in other cases, people have taken it, and that's fine. But you wonder whether they're giving you a fair deal. You wonder, are they charging fees in excess of what the deal was portrayed?
Which goes back to the SEC's question of you can cut whatever deal you want, and the only thing the SEC says it's interested in is whether you're abiding by the deal that was cut.
I think we are fine with that, but that's why transparency is so important.
So, John, if I'm to take these 4 people seriously, you and your type are the source of quite a bit of problems over here.
It's the other guys.
You don't seem pathological, but what's changing in the industry since we've had the SEC on the beat, more aggressively. We've got the Dodd-Frank Act. How is the private equity in the VC space changing its business practice in response to these regulatory forces and also pressure from litigants?
Look, I think that you're seeing a very good effect. You're seeing, for these people that I talk to, there's more disclosure in the ADVs, there's more disclosure in the LPAs, the PPMs are better, and Margot and Sarah are having a good effect, as well as the work of the staff. And I think the other thing, the point that Margaret makes with the advisory board is really important. For us, the engagement of the advisory board is great, because if we can engage with the advisory board on a substantive level, and it's very important to us, we use the advisory board a lot, Aaron's a lot happier. And we like to keep Aaron happy, because if we are able to say, well, it wasn't entirely clear, there was a conflict, we went to the advisory board, we discussed it with a sophisticated group of LPs, they said yeah, and sometimes they say no, and that's fine, and other times they say yes. That makes Aaron a lot happier and saves Drew a lot of time. So everybody's good, back to efficiency.
So basically the idea is, if an ambiguity comes up, because when you write a contract, you can't anticipate every contingency that arises. You've got an expense, for example. You say, I don't know, does it fit here? Does it fit there? How much of this do we eat? Can we keep this? Do they have to absorb that? You call together a group of representative LPs. You present the question, you get their view, and you reach some kind of consensus. And is that kind of an approach persuasive at the SEC?
I think in general contours, yes. I think that the SEC would draw some comfort from advisory boards. I think where we've seen the advisory board issue fall down are sometimes it's not clear to me when I read the LPA agreements, and I don't know if Margot or Sarah have a different opinion, but it's not necessarily spelled out which types of transactions have to be run through the advisory board. Is it just if a certain person deems it a conflict, do potential conflicts need to be, what types of conflicts actually need to be run by these boards? Because a lot of times the examiners go in, or we go in, and there are a whole host of conflicted transactions that have not been run by the board. I also have some concerns, make sure those advisory boards, and as Joe, you've been describing it, it's a group of sophisticated LPs, but make sure those advisory boards themselves aren't conflicted. Does anybody on that advisory board own a piece of the GP? I think that there could be leftover structures from periods and other times, but it's just something to think about. So generally speaking, yes, I think we would draw some comfort from the advisory board, but how is that functioning in practice will be a question.
Well, Aaron, you've raised the issue of conflicts, and Drew, you're out there on the street, and one of the things you're hunting for is conflicts. What kind of conflicts are you finding, and what can PE advisors do to address some of these concerns around the types of conflicts that you're discovering?
I think in terms of some of the broader general kind of conflicts that we run into, our allocation of co-investment opportunities. So a not uncommon examination topic, I'll say, is many LPs get side letters offering them co-investment opportunities. So if I'm a general partner and I've offered, pick your number, 4, 5, 6, 10 LPs co-investment opportunities, and it appears that all of them are going to be offered opportunities equally, well, we'll come in and examine and say, are you in fact presenting opportunities to everyone equally? Or do you present opportunities to your largest investors sometimes and not to others? And again, on that one, that's another one where I sort of say, you can allocate co-investment opportunities however you want. You could do it A to Z and start again. You could do it randomly. You could throw darts. You could say, I'm going to allocate co-investment opportunities to the people who I think are going to give me the most business in the future. All that. But that's what you have to tell people, right? You can't have letters out there that promise everybody a square deal and then pick and choose as you want based on. So co-investment, cross-fund and co-investing across funds. So selling one investment from one fund, an older vintage fund, to a newer vintage fund. A big conflict on either side, right? So you have to have a good process, I think, to make sure that transaction occurs at a fair valuation. Related party transactions. So setting up third-party service providers and requiring your portfolio companies to do business through a certain party. Dual employment. So we talked in the talk last April about operating partners was a good example where I think they were in many cases presented as employees of the firm, and you assume that they're being compensated as part of the management fee when they're not. They're being charged back to the portfolio companies. We've seen legal department bills at the general partner level allocated down to the portfolio companies, again, without proper disclosure, right? If you want to, that's the way you want to run your business, and you have the leverage to do it, but just be square up and straight up with your investors about it. Fee allocation policies and procedures, we talked about that some. Advisory board involvement, and we've talked about that. That I would say is another area in the conflict, not uncommon in our exam program, where I would say up front when the relationship's being formed, an advisory board can be a good mechanism to get LP feedback on conflicts and how to resolve them. So there are certain promises made about when the advisory board will be consulted on what kind of transactions and what type of situations. And again, what our examiners do is come in and say, well, are they in fact being consulted? Or are they being consulted some of the time and not all of the time? Or are they being consulted on the little issues but not on the big issues? And so we see conflicts there. Valuation is one I already mentioned too, I think, where there's
Right, so let's test our law of thermodynamics here, where the Office of Examinations finds an issue that just means that you're going to get a reaction from the Enforcement Division because they're going to bring a lawsuit. Has that actually happened? I mean, is our law of thermodynamics here actually working?
I think it has happened.
Yeah,
yes,
okay.
I think it has happened.
And have you got some examples of situations that have arisen to a level where you actually bring an enforcement action because of what Drew and his people find?
We have. I mean, I think just to echo what Drew has said, I mean, conflicts, they're just a big part of the business in the PE world. And they are there. We recognize that they're there. We're not saying that they can't exist. It's just how do you manage them? Have you thought about them? Have you gotten advice about them? What do you have in place to make sure that you're managing your conflicts appropriately? I mean, I think especially for the bigger PE advisors, I mean, there are a multitude of people that are coming next to around these funds, right? I mean, you've got the LPs themselves, you've got co-investor vehicles, you've got proprietary vehicles, you have maybe credit funds investing alongside. There's a lot to manage there, and I think you will do yourself a real service by getting advice about that.
We've got questions from the audience.
Yeah, I'd love to ask the question.
Would you like, willing to step to the mic? Because that we will have the question.
Regarding conflicts of interest, it's very common in LPAs for there to be a statement that says effectively that the general partner may transact with affiliates so long as the transaction occurs on an arm's length basis. And I wonder, when you and your teams see those situations, it seems like that's like my head explodes just inherently, because can a general partner transact with related parties and have it be at arm's length? Can you ever meet that standard, transacting with an affiliate, or or do you just inherently scoff at that and say that you can't? And I think it's an important question because it occurs all the time in LPAs.
Yeah, I don't know if we scoff at it, right? And I think we're always making the distinction between process and outcome, right? I would argue that in a conflicted situation where you're going to do transactions with an affiliate entity, you are facing a material potential conflict at the least. And so what you'd hope to see as a matter of good process is that there's some mechanism in place to ensure that it's done on an arm's length basis. In the absence of any process there, I think sort of the burden might become higher. But I think what you're going to do is look at the outcome, and theoretically speaking, I could see an example where you say, I'm going to do business with an affiliate at an arm's length basis. Our examiners come in and they say, well, this affiliated entity was providing this service at this price. We've sort of looked around, and that looks like the market price for that service. And I think as an examination function, we might say, well, it's a really lousy process about how to handle the conflict, and it leaves them open to be second-guessed, I think, in terms of what they do. But at the end of the day, it appears to meet the standard that was promised, in essence.
So if we borrow a principle, say, from corporate law, if you've got a conflicted transaction, the courts are going to look at it and apply something called the entire fairness doctrine.
And it's then your burden to be able to demonstrate that the process that you used was procedurally fair and substantively fair. Procedurally fair, you did something like you went out and you did a market check, all right, and you know what the other prices are for other transactions that really are arm's length. And substantively fair, you picked a price that was in a zone of reasonableness of what you find when you go out and you do the market check. Now, I shouldn't say obviously, one can imagine that not in every situation that comes up, people roll out all of that machinery, all right, in order to demonstrate that the transaction with an affiliate was procedurally and substantively fair. But if you don't roll out all of that machinery, you take a certain element of litigation risk. All right. At some level, the SEC may come out, may look at that and say, well, wait a minute. On what basis do you reach the conclusion that that was a fair arm's length price? And if you're not able to support that conclusion, you're going to be more at the tender mercies of the agency than if you've got a documented record as to what you did.
Yeah, it gets interesting actually, because you see in many Form ADV Part 2 statements about these transactions, which but for whether they were arm's length or not would be prohibited, where you see actually the advisor actually is actually conceding in the ADV that these are not arm's length transactions, and so it just seems like there's the tension there seems to be actually very, very high, and so that's just my observation and curiosity.
And maybe sort of a related theme to your question, I would say that's probably closer to what we see more often are clauses that say, the general partner may allocate certain administrative and operational expenses to the fund. It's pretty broad language, right? And so sort of, Joe, to your question about take it or leave it and everything else, the one important, I think, fundamental building block in ours is the advisor's a fiduciary, right? So it has the burden of describing what the deal is to the client in a way that a reasonable set of investors could fairly understand it. So in certain instances, when you have that vague language, if it's a legitimate, you sort of look at it and say, well, that seems like a reasonable person would think that's an operational expense. Or you come into a private equity firm and you realize that after the deal closed, they took their entire research team and their back office and everybody else, and they charge it now back to the fund, and they don't carry any of that cost as a management fee. You say to yourself, well, would a reasonable person understand that as the terms of the deal? And I think in some of those instances, I think we're left to say, I really don't think so. And if you bring it back to where I started, then you say, okay, well, the fiduciary, the advisor, is the one that has the burden to describe what the deal is to the client. And here there's clearly material economic elements of the arrangement that were not fully or fairly disclosed, such that, sort of, Joe, to your point, they could fairly understand what the deal was that was being put to them on whatever basis, whether it's take it or leave it, or take 6 months or whatever.
So again, John, the longer these people talk, the deeper the hole is that you guys wind up finding yourselves in. So do you have controls that you use to put in place to address these potential conflicts? How do you do that? And just as a side, one of the things that I tell people, not just about Silicon Valley, but about large swaths of business, all right, in the financial markets and elsewhere, conflicts of interest are common, all right? And there's nothing ipso facto wrong with a conflict of interest if it's properly managed and disclosed. So there are many situations where you can't avoid a conflict. There are many situations where a conflict actually generates many, many benefits, but you got to be aware of it and you have to manage it appropriately. How do you guys go about that?
There's the higher level stuff and there's the more granular. In the higher level, I think Drew's absolutely right. One morning I came in, our compliance department had replaced our mouse pads, and the top line of the mountain was the 10 lists of 10 compliance rules to keep in mind. So, my kid's mouse pad was gone that I got from grade school, and the top rule was think like a fiduciary, act like a fiduciary, be a fiduciary. And then everything else was specific rules about, political contributions, the whole thing, all the rules, the big rules that you have to worry about. But that top rule has got to where you have to start, because there are going to be ambiguities. And if you start from that point of view, and the sequence that's important, think act and B, that's got to be through the firm. And then the second thing that we found is very important is, and that you need to be obviously a bigger firm to do this, but committees are great at spotting problems and mistakes. So the bigger issues, particularly conflicts issues, we have a compliance committee. You'll want to run it through the committee because if you look at all the studies, I mean, we're at Stanford, this is a place where great inventions happen. Individuals are great at inventions, but committees are terrific at spotting problems. And I think we see that a lot, and so you have a good committee structure. And then from there, we go down to more granular stuff, which is our regular compliance programs. We do quarterly reviews of the topics that Lee cares about and Aaron cares about, and we don't let it build up to the end of the year. So all of that works. And then the last two pieces is really good integration with accounting, because a lot of these conflicts do run around dollars and where dollars flow, and you got to make allocations. Accounting has to be in the room to make Margot and Sarah happy, to make sure things are allocated right. If they're not in the room, they don't understand where they're putting stuff, allocating expenses to co-investors and so forth. It's really at accounting. So we spend a lot of time with accounting. It's not just compliance.
You know, what I'd love to do is open it up for questions from the floor. Yes, sir. Come on forward.
I'm a retired VC. My wife might say a recovering VC. I'd like to ask about the thing that I think the most controversial thing that Calpers has done in recent years that I happen to agree with, but none of my colleagues do, and that is calling for the abolishing of the carried interest. And for those of you who aren't familiar with the carried interest, it's a fiction by which people in private equity and in venture capital take long-term capital gains, pretend that their income is long-term capital gains, and it is a way to run up the federal deficit for the wealthiest people on the planet. And Calpers called a few years ago saying, "Hey guys, enough is enough. I wonder if anyone else has an opinion on that and thoughts on it." And of course, a piece of this is what bucket you put some of these fees in it turns out to change the tax treatment, and it can run into millions, and for some individuals, tens or even hundreds of millions of dollars of shifting tax dollars around.
I think that's a question for Calpers and CalSTRS probably.
And I'm sorry, you said abolishing. Do you mean abolishing the tax treatment on capital, on carried interest, or?
So carried interest is now treated as long-term capital gains.
Yes.
And the call was that it be treated as ordinary income, not long-term capital gains.
I have a very, very, very strong opinion on that. I don't think my opinion matters. I mean, it's a matter of tax policy and equality and you know, who should be paying taxes in the country. But as far as being a fiduciary to our beneficiaries, you know, that the tax code is what it is, and we want our, you know, we're evaluating performance. Sorry.
Sarah?
Calpers actually doesn't, well, we haven't taken a position either way. It's up for the government to figure out what they want to do tax-wise with carried interest. You know, people may have views at Calpers about that, but Calpers has not taken an official view that it should be treated as income and not capital gains.
We had some other hands. Yes, sir.
This is very interesting talk. Not everything else being equal, conflict of interest, regulatory issues, transparency, would a GP that puts some co-investment be, from a regulatory point of view and investor point of view, be more or less comfortable in the role? What I mean is that if a GP is acting purely as a general partner without any aligning of interest with cash invested, does it make any difference?
Makes a huge difference. But sometimes, in theory, it makes a huge difference. If you exaggerate it and somebody's, say, left a large firm and is worth a couple $100 million and says, I'm going to put a couple $100 million into the fund and I'm only going to raise $800 million, then that's somebody, all other things being equal, you want to be partners with.
Yes, but yeah, here
is that the question?
Yes, that is the question.
Else who says I'm going to put in
4,
1%, and by the way, I'm going to do something called fee waivers. Not actually put anything in.
Right. Okay, so symbolic numbers don't make much difference.
And it's just one. It's just a small factor. If you look over the lifetime of a fund, if they're taking 1.5% a year during the investment period, and you look at all the fees, you might say over the life of the fund they're going to take 14% of commitments. And so one person says, I'm going to put 2% in of commitments as my co-investment, and another person might say 3%, and you do some math and you realize, well, both of them, depending on how many people they hire, are basically taking your fee to pay for their GP commitment. So, I'm always a little cautious for someone who says, wow, this one's putting in 3 and this one's only putting in 1. May or may not be significant.
Asset class, does it make any difference? Real assets versus financial instruments?
I think the principles apply. I mean, in general, buyout firms tend to put in more, but the same principles apply.
Got another question, Mr. Schatz?
Hi, I'm JD MBA here at Stanford, and this has been great. Margot, you alluded to the fact that in 2008 there was a shift seemingly in bargaining power between LPs and then the remaining high-performing GPs. With the not-so-secret growing pension obligations that most states are facing, are you under increasing political pressure that is further driving a diminished bargaining power for you when you're dealing with GPs? That's because you need to sort of see certain returns that only alternative asset classes can provide. So that's my intuition, and could you confirm whether that's right? And then the second question would be for the SEC folks, are you seeing more egregious or more frequent violations post-2008 as you've seen a shift, if it does exist, in bargaining power from LPs to GPs?
I would say, I'll go back to 2000, and I would say, wow, this was a great asset to be an LP in. And the day I walked into Calpers was a very good day in my life. And it was if you were in the LP, if you were in the private equity asset class at a public pension, you were a hero because you were knocking it out of the park. But the industry has matured and become more efficient, and it's made it harder to make a return, and it's still growing. And so I think we are not under pressure to put out more than we think is comfortable, but the value proposition has changed. It's a lot less certain now that you'll be able to make out returns. I mean, for a while we were outperforming public markets by 10%.
For Calpers, Calpers actually decreased its exposure to the private equity asset class from 14% to 12% about a year ago. So while Calpers is underfunded and there is a desire to have a higher funded status, and private equity is the area where alpha is expected in the portfolio, it's not driving us to increase the exposure to private equity.
Other questions?
Can I chime in on the regulatory end, so your second part of your question? So it's similar to, and one thing I probably should have said at the beginning, in terms of sort of egregious violations and those sorts of things, I mean, one of my observations is always too, I think we shouldn't get lost in the fact that most of the people in the industry are really trying to do the right thing by their clients, by their employees, and, by our markets. And so we tend to focus in the exam program, we're focused on deficiencies, not on what people are doing right. So I'm always a little bit leery when you come up and talk about these things. People leave with the impression that, it's a cesspool of misconduct. And I think for the most part, we certainly do see misconduct. Sometimes it's egregious, but I don't think it's fair to sort of paint, the whole industry with that. In terms of your specific question, in terms of changes since 2008, again, the private equity firms in particular didn't come online for us for examination until like 2011. So we've been doing exams for about 2, maybe 2.5, going on 3 years. And we really don't have enough data to make any conclusions about the way things went. I think, what we're seeing from our position in the market right now is since registration over the last couple of years, our sense is, and I wouldn't say it's directly attributable just to us, right? I think it's a lot of issues. I think it's work by the limited partners. I think it's other things. But what we've seen, I would characterize generally as kind of directionally correct in terms of improvements in disclosure, more proactive inquiry, focus by the limited partners in terms of what they're doing, and other things. Again, I don't think any of us are ready to blow the all clear whistle and say we're moving on, and we're not going to look there anymore. But that's a high level overview. Hope it's helpful.
Thank you. My question is specifically more about venture capital and how some of the concepts that you were talking about earlier in the talk, not to fees, but more about valuations and pragmatic and efficient financial strategies for investment, how those factors are looked at both from a regulatory standpoint and an institutional standpoint in the realm of venture capital, where the data is all over the place and the valuations are kind of crazy from a quantitative standpoint, and where the fundamentals are looked at in a very different way. So how does both the SEC and both like an institution approach their agreements with venture capital funds that are investing in technology?
First, go ahead. Mine's easy. I'll do it first. Let's come right back.
Okay.
Ours is just what do you tell people you're going to do in terms of valuation? How do you describe to them how you're going to make those sometimes, admittedly, difficult determinations? And do you follow it? Is that what you're actually doing? Or are you reverse engineering particular results or not following the process that you disclose to your investors?
And there has been certainly some academic literature on this subject, but I think it may hit the VC side of it more, just because the valuations are going to be more difficult given the level of data that you have. But just, are you changing your valuations in times of marketing? I think there's this sense that valuations don't matter till the end, but I think that there's certainly some talk about the fact that firms may be marking up their valuations when they're going out and fundraising and then marking those assets back down. So just really being conscious of what you're doing at the time, who's involved in the valuations. Do you have a marketing person sitting in on those committees saying, can we just go a little bit higher, things like that.
Sarah, Margot, valuations, venture capital?
The valuations, they're going to be extra subjective, and especially in early stage. These are maybe pre-revenue companies, and it's just highly speculative, and maybe there's subsequent financing rounds which might indicate some third-party collaboration, but even that can be suspect. So, with more uncertainty, you have to filter that in, and you might have two firms whose previous fund are both at 2x capital, but one might be have returned 100% of your capital, and it's another 100% in terms of unrealized in valuation, and another one might be at 2x and only be 25% of that's actual in the pocket. So you're going to give a lot more credence to the realized returns. But and you would also look at the hopefully longer history of the firms and seeing what their valuation practices are, and look at patterns of valuations as they get close to fundraising. And
so if I understand this
maybe spot check a couple of them. And
you give some leeway in the case of venture capital because kind of the academic literature is kind of nebulous, and the financials are also very different. You kind of leave it up to the fund to make effective choices.
Well, when it comes to valuation, I mean, the general partner is and used to be agreements would say that we're going to value a certain way, and different funds would value different ways. But now the accounting standards are such that if you're audited, you have to value on a fair market value basis, which also doesn't necessarily tie it down, but typically we're presented the data and we have to interpret it the best we can.
Right, time for one last question.
Thanks for your questions.
We've got one all the way in back. Come on down.
This is maybe a question more for the LPs, but it seems that one of maybe the unintended consequences of the new regulatory regime seems to be that it favors the scale economies of a large fund versus a smaller fund because of the fixed cost of compliance. Also because there's, with the transaction fee offsets, there's kind of less money there for the smaller funds to afford groups like operating partners and people like that. And it would seem that, again, one of the consequences could be you will find over time less innovation, less creation of smaller GPs to the favor of the larger GPs, because the economics of the industry, because of all these fixed costs and changes in transaction fees, are favoring the larger GPs. And I'm interested from an LP perspective how you view that.
I mean, I think the answer is yes and no. That the large firms have tremendous infrastructure and have a tremendous advantage and trade name value, but smaller firms and also I mean a tremendous salary load. I mean these are behemoth of organizations, but a smaller firm can be nimble and can operate on smaller salaries. They can, and I think, again, if you go back to 2000 when I started, we would interview people with MBAs and ask them questions about private equity, and they really, what's the difference between venture and buyout? And they couldn't answer, but now it's taught in school. So I think, part of the problem now is probably being a tweener. I think there's a lot of pressure on the firms that don't have those resources of the big firm, but aren't as nimble as a small firm. But I still think there'll always be a place for newer firms, smaller firms.
And I would echo that. There's beyond just the infrastructure and regulatory increased infrastructure for regulatory compliance. Big firms can, because of their scale, just more efficiently do a lot of different things. But there are going to be individuals at those firms that decide that they would rather be in smaller firms, and properly motivated people will find a way to deal with the increased cost of running a firm.
A smaller firm is probably more likely. We used to always think triple. We want our GPs to put the money out and triple it in 5 years for each investment they make. With a bigger firm, that's not a realistic expectation on the average, especially in this lower return environment. So maybe it's double. But a smaller firm has a higher chance of producing those outsized returns. And so the foundations and endowments that don't have to put out as much money as Sarah and I do favor those smaller firms.
I'll just throw my 2 cents in, which is, and this is, so I've been around, I told you, for like 25 years in the industry. So when I was in the industry and I would be on panels like this, a lot of the older people would talk about, growing regulation, because it has increased, right, over the last couple decades. I don't think there's any two ways about it. And they would sort of lament and say, I'm going to get out of the business. There's too much regulation. It's not worth it anymore. And even when I was in the industry, I'd always look at them and say, what are you talking about? Like, this is the greatest business you could possibly be in. You're helping your clients. I think if you look at McKinsey studies, the average asset manager, I'm not even talking about private equity, the average asset manager has margins of 25 or 30%. Like, who else out there is in a business that's good? And I look at, it's sort of interesting for me for private equity in terms of all we've seen, where we have seen some misconduct and things like that, is I always think, like, to my simple mind, I think, like, the people in private equity, they have the greatest, they're actually adding value for their clients. They're getting paid really, really well. If I was in that position, the one thing I would think to myself as I skipped to work was, like, just let's not mess it up. This is the greatest thing going. I'm helping people, and I'm doing okay myself. And so my view is on the smaller ones, I still think this is one of the, I tell my son, I have a teenage son, I say, Cole, you want to go be in private equity? Like, that's where to go. Like, that's a great, that's a really good business. That'll be good for you. So for me personally, there's a share of opinions. I really...
I would love to hire your son, by the way.
So on a let's make our closing note. Let's not mess it up. All right. I'd really like to thank Drew and Sarah and Margot and Aaron and John. You guys have been fantastic. I know I've really enjoyed the time we spent together. I hope it's been useful for you too. Thank you. Thanks,